Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi there and welcome to the Better System Trader podcast. Glad you could join us today. The title of this podcast episode is Backtesting Trading Strategies Does Not Work. Got your attention? Well, perhaps you already agree with this statement, or maybe you strongly disagree with it, and perhaps you're currently heading out to the backyard to grab your pitchfork. Or maybe you're just shaking your head thinking, what the heck, Swanee? Have you finally lost it, man? Well, the good news is, no, I haven't lost it just yet, and all will be revealed on the podcast a bit later today. We're going to dive deeper into that statement and what it actually means, so look out for that one. But first, our guest for this episode is Mr. John Ehlers. Now, John is a friend of the show. He's been on here a couple of times already, discussing a variety of topics, including cycles, indicators, digital signal processing, and in our chat today, we're going to tackle robustness and also intraday trading. So some of the things you'll hear in our chat today are the differences between intraday and daily timeframes and the critical factors you need to watch out for. We'll also be discussing why it's difficult, or why it's more difficult to predict where market prices are going on an intraday basis compared to the daily time frame, and how you actually need to think about intraday data differently. Well, as I mentioned, we'll also be digging deeper into this backtesting trading strategies does not work statement to find out what John really means when he says that. We'll also look at genetic optimization a little bit and how to use a simple genetic optimization trick to determine the robustness of a strategy, and also how to use genetic optimization to identify suitable ranges for optimization parameters. Plus, we're going to talk about a whole lot more. So let's get started. Let's jump over now to my chat with John Ehlers. Hi, John. Welcome to the show. It's really great to have you here again.
Hi, Andrew. Thank you for having me.
Now, you've been on the podcast quite a few times now. We've covered some really great topics. Some of the stuff we've talked about before, cycles, DSP. We've talked about indicators, adaptive and responsive indicators that adjust to the markets. We've talked about zero lag, all kinds of stuff. So I'm really excited to hear what you're going to share with us today. But first, how about we start with a little bit of background on yourself for the new listeners. So perhaps can you share a little bit of your background and how you got started in the markets?
Sure. I'm a retired electrical engineer, and during my work, I was exposed to a technique called maximum entropy spectrum analysis, or MESA, and I couldn't use it in my work at the time, but I happened to get a bonus, and so I knew I could apply this MESA technique to actively trading the market, because the MESA would be appropriate to the short data lengths that we have to use in the market, as opposed to Fourier transforms for dealing with cyclic information. So I started using that, and once I started using it, it went well, and so I started writing about it and going to conferences, and before I knew it, I was a vendor selling the MESA programs. And in general, my background from engineering is in information theory and signal processing, and so that's been consuming most of my time since I've retired.
Yeah, I think it's fascinating the way you use that in the markets. And I think we're going to talk a little bit about that later. But if we fast forward to today, what markets are you trading? Can you give us a little bit of an insight into trading styles, timeframes, that kind of thing?
Sure. Up to now, I've been trading daily markets and daily across a wide range of futures contracts, from the meats to the grains, and I've generally settled in on the stock index futures because the indices are themselves averages, and when you're using averages, it kind of eliminates a lot of the news flashes that cause markets to get yanked around quite a bit. So you, in a sense, have a portfolio when you trade an index. And so more recently, I am intrigued by the idea of getting greater return on my capital by trading intraday because the margin requirements are less. And there's a startling difference between intraday data and daily data. In the stock indices on daily data, most companies have to make their numbers by the month, and as a result, I've found there's a general underlying 20-bar cycle or a monthly cycle, and that's what I have been able to take advantage of over the years. But switching to intraday data, there just isn't that a persistent cycle period there, and you have to be a lot more agile and pay attention to critical factors in signal processing, like eliminating the lag of your computations.
Yeah. So I know that you've done a lot of cycles work in the past on daily data, and you just mentioned there that intraday is very has some very different characteristics to the daily charts. But is there anything else other than that, the absence or the reduction of cycle data in intraday? That are there any other challenges there that you've seen or differences between the two timeframes?
I don't know if they're exactly differences. The daily charts, it's relatively easy for me anyway to get the same results out of sample that I have on in-sample backtest. However, because the intraday data is non-stationary, I find that there are stark differences between a historical backtest of a strategy with in-sample data and then using out-of-sample data. They can be dramatically different, go from an excellent strategy to a very poor one. And so one has to be super careful in using out-of-sample data to evaluate your strategy in intraday data.
So why do you think that is, though, that intraday data is different in that perspective? Do you think that maybe things change quicker on intraday because there's more bars? Because I know in the past, I think in one of our previous podcast episodes, I think you was saying something about the market is fractal across the different timeframes. Or maybe that wasn't you. I'm not sure. Is that something that you sound like you've said in the past?
That certainly is true. That has the fractal nature of the market data has to do with the spectral structure, and it means that the noise level in the market is not flat across all frequencies. And it just almost every trader can realize or recognize that the longer cycles have a bigger swing. It's that simple. And it's true in intraday data. But the problem is that there's, as far as I can tell, no particular cycle that you can take advantage of. You have to be, instead of thinking in terms of a quiescent sine wave that's swinging back and forth, you now have to be more agile and create an indicator that has less lag, and you can statistically catch the swing movement. And the best you can do is to have a low lag indicator. You can't anticipate. I guess that's it. That summarizes it. You really can't make a valid prediction where the market prices are going using intraday data, not as in comparison to daily data.
Yeah. I guess sometimes you can see persistent behaviors in certain parts of the day, though, when you're looking at intraday data. So does that perhaps lead to maybe there is some cycles in there, but they're harder to determine using the approaches you've been using on daily charts?
Yes, they have to be. You have to be. I think I used the word agile. Instead of just being focused on a swing trade that's reversion to the mean. Many times in intraday data, you'll get a trend that lasts over 3 or 4 or 5 days. And so you have to be able to recognize going between a cycle mode where you're looking for a reversion to the mean and going into a trend mode where you're basically trading on a momentum style trade. And so you have to mix your techniques in a very fast way to take advantage of both modes of trading.
Yeah. I did actually see, and I think it was an article you posted on LinkedIn just recently about a market regime filter that switches between cycle or consolidation and trend following. It was using phase angles, I think. So that was quite an interesting article, I think. And I think one of the things that I really like about your work is you look at things from, not you use a lot of DSP in your work and the cycle stuff, which is not, I don't think it's used a lot out in the market. So it's quite a unique way to look at, to process this market data. How do you come up with all these ideas?
Just sitting here and looking at a screen a lot on the indicator you described. It does exactly what I was trying to do, to switch between a cycle mode and a trend mode. And if you think about the definition of a cycle is the rate change of phase. And so if you make an indicator where you're just measuring the phase, you can see it change from bar to bar to bar. And so you're in the swing of a cycle. But if the phase stops moving and it remains steady, then the cycle has stopped, and so you've gone into one of these trend modes. So you got to switch your strategy from cycle to momentum according to what this indicator is showing you, and you have to be so fast in recognizing these changes. And to a degree, you almost have to think in a different way. Almost all traders look at indicator lines, squiggly lines, I call them, and that's what's happening in the time domain. But you have to think about what's happening, in my opinion, you need to think about what's happening in the frequency domain. For example, a squiggly line is a composite, can be synthesized from several combinations of primitive sine waves. And so you need to look at those constituent primitives to assess what may be going on in the future. For example, it's switched into the trend mode because they've just basically gone away.
Yeah. All right, John, I just want to switch the topic now, actually, to robustness. Now, I saw on your website you have a white paper that you've published. It's called, where's the name of it? Here we go, A Procedure to Evaluate Trading Strategy Robustness. Now, it's a great article. I really love the start. The very first line in the article is, backtesting trading strategies does not work. I thought...
Yeah, statement of truth, huh?
Yeah, what a way to get started. You drew me in straight away. So can you explain why you said that? What do you mean by that statement?
Well, you've seen any number of strategies that are advertised. And for example, if you go to Collective 2, and you can see how the strategies look before they were released. And then after the release date, they fall apart. that's kind of in sample and out of sample differences in how the trading strategy performs. And in particular with intraday data, there's a dramatic difference between what you're looking at in a historical backtest of the strategy, because it's in that backtest the platform has selected one combination of parameters out of several 100,000 or more, maybe more than 1 million combinations, and you have that one combination that gives you that performance, when in fact the probability of the performance lies conceptually as a bell curve along the profit line, and you're going to get substantially less profit statistically than you got by that 1 in a million shot on back-tested history. So the test for robustness is a little complicated, and but what you do is you take advantage of the genetic optimization in the platforms, and you set the number of trades that you're able to look at in the optimization in the platform, and to make sure that you captured all of them that occur during the genetic optimization. So you throttle back the number of optimizations that you actually do genetically, so that you can see all of the growth of the performance as the genetic algorithm progresses. When you do that, my whole observation started with, this whole concept started with the idea that when I genetically optimized, I saw that a really good strategy would jump to the final solution or near the final solution almost immediately. But if a strategy that was not so good, would take a long time to get to the final solution, which means to me that the probability distribution is toward near that one solution, that one best solution, if it consolidates near the final solution rapidly. So when you do this and you look at the profit performance, you click on the top of the net profit scale, and so you organize all your elements according to net profit, and you can in fact see the slope of the net profit as a function of the optimization. The optimization number or the various combinations. And it's important because the genetic optimization consists of two parts. One is the generation, and I generally use 100 generations, and the other is the population. Well, if you set the population to some fairly small number, the genetic algorithm randomly selects among that population, and you set the number of generations to 1. So you're looking at just the random selection of combinations that get you to the best final solution using a genetic optimizer. And when you look at these results, it's a little tough to describe without charts, but you'll see that when you have a good strategy, you have a large number of combinations that are near the maximum. And if you have a bad strategy, you'll have a peak solution and that has a good solution, but the remainder of the solutions have a profit that falls off dramatically from the peak. And in fact, in a lot of cases, you go into negative territory in over half the combinations that you have chosen randomly. So it's this procedure that I use that started with my observation that when you got a good system, it's going to genetically optimize rapidly to the final solution.
Yeah. Yeah, that's an interesting idea. I guess genetic optimization is typically used if you've got a huge range of iterations to test, and it's not practical to do an exhaustive optimization, and those numbers can really jump very quickly as you start adding more parameters. So you go 2, 3, 4, you can easily end up with 10,000, 50,000, 100,000 iterations. But
I like to open when I optimize. I like to open up all possibilities, and I might have like 6 or 7 different parameters, and so it's not uncommon for me to have tens of millions of combinations.
Yeah. But yes, I was going to suggest, could this really be a factor, the number of possible iterations, or is there a minimum number of runs you really need to be able to measure the slope as you were suggesting?
That's kind of a wide open question because it depends upon the range of your parameters, and if you neck it down too severely, then your in-sample and out-of-sample results have to look the same because you're using the same parameters. So it's self-defeating if you use too few parameters. You don't open yourself up to really see the variability in the robustness or the sensitivity of your parameter changes.
Yeah. And what about the randomness of the genetic optimization? It just picks, some random values to get started. Do you think that has a lot of impact if you have the numbers too low?
It possibly could. I set my platform to look at a total of 2,000 optimization trials. And so I set my population to be 40. So a combination of 40 population and 100 generations gives me a total of 4,000 possible trials, but because of the randomness, you only use the platform usually only uses about half of them or less. So it's setting those ranges in a little bit of an art form.
And so when you're looking at the results of these genetic optimization runs, are you using any particular metrics, or are you looking at groups of metrics, or how do you actually judge that when you're trying to define or measure the slope?
I'm looking at all the combinations, and so the top 50% of the combinations represent a good sampling size of all the possibles. So my metric is pretty simple: is how good is my net profit at the 50% point compared to the net profit at the maximum, and that ratio is my figure of merit for a strategy.
Right. Okay. And then are you using these the genetic optimization results to pick a particular set of values that you could use, or are you just using this as a general robustness test and you're using other techniques to identify the values?
I use that procedure to select the range of parameters that I'm going to use in my walk-forward testing. You in that table, when you organize it by net profit, then you can look at how each one of the parameters varies relative to the net profit, and that will give you a pretty precise picture of the range of values you want to use in any walk-forward testing.
Yeah. Okay. So if you are doing this test over a wide range, and you see that there is a peak in the middle, is that perhaps suggesting that the range is too wide, or there's certain sweet spots, in those parameter ranges that you should test? Because I think you made the statement that if you see a peak like that, then perhaps it's not a good result, but maybe there's some other information there that it's telling you with the shape of those results.
Even when you use genetic backtesting, remember that you're looking over a given block of data. And so you're looking at the average results over that block of data. What you're looking for is you're trying to get the most robust performance across that range of data. So not only do you need to test over one block of data, but you need to step it over different time frames to make sure your strategy is robust. And of course, you can use your platform's walk forward optimizer to further test that, but that's got its own set of problems necessarily.
Yeah. Actually, I saw a paper that you published on your website about walk forward, and you've you raised some of the problems and some handy tips as well on what to do. Can you share a little bit about that with us?
Sure. It's procedurally they set some default settings. For example, if you're doing a walk forward test, they force the out of sample percentage to be 30%. Well, if you're doing your own walk forward testing, you want it all in sample during the whole test that's run. So because you're going to look at it as a walk forward with using all the available data. And the next thing you got to recognize is do not use genetic optimization when you're doing a back test, because genetic optimization will skip some parameters that are crucial to your strategy over the duration of data that you're working. So you have to use an exhaustive test, which limits the range of the parameters that you need to test. And then once you get into doing the walk forward test itself, on intraday data, I use 2 months of back in-sample data and walk it forward 1 week at a time. And the reason I use 2 months of back data is if I'm trading every day or approximately every day, that gives me about 40 trades of in-sample. That gives me a reasonable, I want more than 20 trades, say, to get a reasonable expectation of the correct average parameters to be using. And then walk it forward 1 week at a time as a single walk forward optimization. All that business that in the platforms about cluster walk forward, that's very confusing and it's a waste of time. And if you're doing a walk forward, you want to walk it forward as if you were going to use it in real time trading. And so, as I said, using 2 months of data and walking it forward a week at a time is the procedure that works for me. And then assessing results, I just don't look at anything except the resulting equity curve. And the equity curve out of sample should generally represent the equity curve that I had in sample, with some allowance for degradation being out of sample. And it's that simple.
Okay, I think it's interesting that you leave just a week of out of sample. I've never heard someone have such a short out of sample period. Do you think that is that based on anything other than like a personal preference? Have you tried longer out of sample periods? Because you did suggest that the markets change pretty quickly on an intraday time frame. So is that kind of what's guiding a low out of sample or a short out of sample period?
Yes, it seems to be for me what works the best with the strategies that I've developed. It's I guess the best way to look at that is look at daily data on the S&P futures over the last year and a half, and you can see dramatically how it's gone from. In 2017, it pretty much had a smooth trend, not much volatility. And then now the volatility's gone wild in 2018, and you just got to stay ahead of both conditions: the momentum mode in 2017, or the more wildly swings that we have here this year.
Yeah, and obviously that's also based a little bit on your trading style. So such a short period may not work if you're a trend follower on a daily time frame where the trades are actually longer term. So.
Oh, absolutely, absolutely. It depends upon the specific strategy that you have. Yes, and your style.
Yeah, yeah.
I found that in intraday trading, I try to write a program that trades about once a day. Yeah. More than that, I tend to overtrade, and so that gives me plenty of action to keep my interest alive, and yet I'm not spending all my money on commissions.
Yeah, yeah. So I guess we know what you do on the weekends then. You're re-optimizing your strategies every weekend.
Actually, once you have the strategies, it doesn't take that long.
Yeah, yeah.
It's pretty straightforward.
Yeah.
Yeah. Most of my time is spent in research and developing strategies.
Yeah. Okay, now I just want to ask you one more question then, actually, about I noticed you've launched a website called Be Your Own Hedge Fund. Can you explain what is that and who is it for?
Be Your Own Hedge Fund is for people who have an IRA, for example, and want to take active command of their own trading, but really recognize that they're not a rocket scientist and they don't know all the techniques of signal processing, but they still want to be actively involved and they want to maximize the return on their capital. So, first of all, one way of offering a hedge against losses is to deal with the portfolio. And so what we have done and built Be Your Own Hedge Fund is we've looked at about 600 of the large cap stocks, and we've created portfolios that have a maximum position sizing of 1, 2, 3, or 4 stocks. One stock is just a single stock trade, of course. So, for example, if you have $30,000 that you want to be actively involved with, you can use a maximum of 3 portfolio and follow our timing to trade a maximum of 3 stocks at a time out of this universe of about 600 stocks. And so it's a way of being relatively conservative, and it's self-documenting. We always enter on we give a signal at the end of the day for exercise at the next open. And we do that primarily because we can follow the opening price as a published price, and we're 100% transparent. We show performance back for the last 8 or 9 years. Trade, you can dig in and see it trade by trade in that kind of detail if you want to, or you can see it from an overview on a month by month basis. So it's fairly easy to see how we have performed because it's all self-documenting. And so it's for those traders who don't have the time or the expertise to do their own analysis, but yet want to be take an active control of their own investments.
Yeah. Now, I know as well that you have a solution for traders who do like to do it themselves, and you've got a workshop coming up this year, or a bit later in the year. Can you share what you'll be covering in the workshop?
It's an intensive 3-day workshop where it's a very small audience, and it's a one-on-one learning experience. My catchphrase for it. I offer left-brained solutions for traders in their right minds, and so I go into all the technology of the data and why market data is what it is, and how to successfully attack it with indicators and then specific strategies. We go into how to test it and establish robustness. And so at the end of the 3 days, traders will go away with no less than 7 daily strategies that they can use across all ticker symbols, and no less than 7 intraday strategies that are primarily aimed at the index futures markets.
Yeah. Yeah, so for people who want more information about exactly what's in the workshop, I'll have a link to that up on the show notes page for this episode. Now, I know every year, because I've been to the last couple of workshops, every year you introduce some new research. So what have you got in store for workshop attendees this year?
Well, the high thing on my agenda is to get the idea of robustness across. I know people are aware of the difference between in-sample and out-of-sample strategy, or strategy performance, but they need tools to how to assess the differences and how to establish whether a strategy is robust or not. And that will be a large piece of what I'm talking about. Of course, we'll talk about the out-of-sample performance and genetic optimization and how that fits into the big picture. But I'll also be disclosing my MESA algorithm, the one that I've used since the mid-1970s to measure cycles in the market. So that's a benefit, that I only disclose that during the workshop.
Yeah. Thanks for explaining that, John. So I usually finish up with some quick closing questions, but we've done that a few times now, so I'm not sure. I want to keep asking you the same questions there. But so for people who wanted to learn more from you, though, where can they go?
I have an education website. It's www.mesasoftware.com. And there I have a page devoted to papers that I've written in the past. More recently, I've addressed genetic optimization, so that's kind of at the top of the page. I have another page referring to optical illusions, where I show that people are really well tuned to recognize patterns, but I'm afraid in the market they recognize patterns that just are not there. That is, I don't put a high reliance on things like double tops and double bottoms, because those are just anecdotal in my opinion. So, and I use these optical illusions to illustrate the point that kind of see what you want to see in many cases.
Yeah.
And there is another page, another page on mesasoftware.com where it's a complete cycles tutorial. So that gives a pretty basic background of all the information about cycles as they pertain to trading.
Yep. So I'll have a link to the website as well on the show notes page for people who can't check it right now, maybe driving their cars or something. And also the as you mentioned, the first two white papers we discussed actually today about strategy robustness and genetic optimization are up there as well. So if you want to, and you got some charts in there, some pictures, which would probably make it a little bit easier than us trying to explain it over the in audio. But I recommend people go and have a look at that, and you might get some great tips from that. All right, John. Well, thanks a lot for your time today. Is there anything else that you wanted to mention before we finish up?
No, thank you. It's been my pleasure. I enjoyed it.
All right, thanks a lot, and I wish you all the best.
Same to you.
Cheers, John. Bye.
Bye.
Okay, well, that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.